Everyone. My name is Robin Sheremy. I'm the Dean in the Coles College of Business. On behalf of our other two deans, John Preston in the College of Computing and Software Engineering and Kojo Mensah-Wilmot from the College of Science and Mathematics, and obviously our host, BlackRock, we are thrilled to have everyone here this evening for a very lively conversation. And we're in our second part of a four-part series that we are the three colleges are working together in an interdisciplinary manner to bring BlackRock to you and talk about BlackRock as well as the field of investment from an interdisciplinary approach. So before we get started too much, I wanted to let all of the students know and everyone present in this room that we are recording this session. So we're here to inform you that this session will be recorded and we can have it for students to view at a later time. I'm going to first introduce Lupus Pilgrim, who is a Global Consultant Relations Associate at BlackRock and a former KSU student. We've got lots of KSU students, some former ones and current ones that are on the panel today. He's a graduate of Wellstar College of Health and Human Services, and he graduated fall of 2013. I hope he doesn't mind me sharing that, but I already did. But we are thrilled to have Lucas kind of lead first. So, Lucas.
Perfect. Thank you, Dean. And welcome everybody back to the BlackRock Speaker Series here with KSU. As mentioned, my name is Lupus Pilgrim, proud KSU alumni going back to 2013. I've been with the firm for about a year now and super excited to be a part of the team and be a part of what BlackRock is building here in Atlanta. And while we hope you were able to join the previous panel that the dean mentioned, where we talked about what I wish I knew in college, and where we gave a full kind of in-depth overview of the firm, we hosted a panel that kind of included a range of employees that kind of talked about their experience of transitioning from the classroom to the workspace. But today we're going to kind of keep it brief on the firm level and spend a majority of the time with Shayan as he kind of provides context around his role, his responsibilities, and kind of the state of the current markets. At the firm level, BlackRock is really proud of our growing partnership that the dean mentioned with KSU. And the speaker series is really, I will say, the beginning of the partnership. It's kind of a natural fit between the range of KSU programs and the diversity of the student body. They're both are very well represented here across teams. Kind of BlackRock at a high level, we're a firm managing money for organizations across the globe. And while most generally associate asset management with portfolios, equities, fixed income, kind of monetary transactions, many BlackRock employees are responsible for things like protecting client data, maintaining a global brand, building client relationships, creating a safe workspace in today's state of COVID. And what's even more important and most important to the leadership team here at BlackRock, it's a collaborative effort across all teams and all roles of building a strong culture. Honestly, the list of job descriptions, roles, and responsibilities here at the firm goes on, but really what's universal is the theme of teamwork and culture building. As I mentioned, kind of worldwide firm presence in countries all around the world. And with over 16,000 employees, local relationships are critical to our success. And a lot of the jobs that I described and the responsibilities that the team takes on starts with student engagement and engagement with universities across the world where employees have graduated from and universities that are present in the cities that we all work and live in. Now, I'm not going to take up too much of our time here kind of talking about the firm because I know we're all excited to kind of hear from Shayan, but I do encourage everybody to connect with the BlackRock folks on LinkedIn. Be on the lookout for a follow-up email that details our analyst program, roles here at the firm, growth across the market here in Atlanta, and really offices all around the country, all around the world, as well as kind of details on the KSU and BlackRock partnership and what to expect and future sessions. And with that, again, thank you everybody for joining us this afternoon. We're excited for the partnership. We're excited to get in front of the students and start to build relationships there. And with that, I'll kind of pass it back to the dean if you want to introduce our speakers and go ahead and kick us off from there.
Thanks again, Lucas, and thank you to our other KSU alums, Stephen and Elgin, who are also our BlackRock representatives here on the call today. It is my pleasure and honor to introduce our BlackRock facilitator this evening, Mr. Shayan Hussain, who's the Managing Director and member of the Multi-Sector Fixed Income Product Strategy Team for Global Fixed Income based in New York. He is a member of the Fundamental Fixed Income Executive Team and the New York Leadership Team. He's responsible for developing the taxable fixed income platform and providing a link between the investment teams and client groups. He's a senior product strategist dedicated to the firm's multi-sector mutual fund offerings, including BlackRock's Core Bond, Total Return, Strategic Income Opportunities, and Strategic Global Bond Funds. Mr. Hussain joined BlackRock in 2009 and has played a significant role in the development of the firm's multi-sector mutual fund platform by working with investors across both retail and distribution channels. His experience with the firm is time spent in London office launching the firm's global unconstrained fixed income product across EMEA, Asia, and Latin America. Prior to joining the firm, Mr. Hussain was a trader on the U.S. interest rate swaps desk at J.P. Morgan. He started his career in corporate finance with AT&T, working on strategic initiatives, including public debt offerings, business unit spinoffs, and asset sales. He earned his MBA from Columbia Business School and a BS in Business Administration and BA in Economics, cum laude from Boston University. Welcome, everyone, Mr. Shayan Hussain. Mr. Hussain, you're muted.
The muting so I don't interrupt, but just like to say thank you very much for kindly inviting me. Professor Hariharan and the entire KSU staff. It's really an honor to be a part of this series. And there's obviously a ton going on in markets, and we're happy to talk about that. Happy to talk about careers too at BlackRock and more broadly in finance. So, as we noted, I started out in corporate finance doing M&A. Moved over into capital markets in a trading function with JP Morgan on the swaps desk, and now at BlackRock. And Lucas talked about the culture, and I can say, I just want to kind of emphasize that, in terms of the experience that I've had at BlackRock. I think, I've been here 11 years now. It's kind of shocking to say I've been here 11 years, but I never thought I'd be at one company for 11 years. But it's been an amazing experience, and part of the reason I've stuck around is, the culture is just fantastic, highly collaborative, and things are changing all the time. It's not just markets that are changing all the time. The organization itself is changing all the time. I tell people, when they're interviewing at BlackRock, for people considering BlackRock, if you're not comfortable with change, then, this may not be the right place, for someone. But if you get energized by that, then it's a pretty amazing place. So, it's a very dynamically managed organization, and we've been ahead of the curve on a lot of big, kind of shifts in the market. Number one of which you probably know, we run iShares, which is the largest ETF franchise in the world. So, one example among many. One point I'll note, actually, I just realized I need to update my bio. So just to clarify, actually, I moved to Atlanta last year, so roughly 1 year ago to the date. Moved to Atlanta and joined the Atlanta office located in the city. And after being born and raised in Connecticut, my undergrad in Boston, as you noted, and I lived in New York for 20 years. So I'm a true Northeasterner. When we opened the Atlanta office, I was just from talking to everyone, just so energized around what we're trying to do here, which is really to create a microcosm of our other major offices in New York and San Francisco, where you have a multitude of functions, from marketing to, kind of trade and operations to investments. So part of the reason, for my move down to Atlanta is to actually help build the investments function in Atlanta. So in addition to my kind of normal day-to-day, in terms of being a strategist and working with our investors, I'm also working with our senior leadership at BlackRock to help think about how we build an investments ecosystem in Atlanta. And we have some pretty cool pieces in place. We have some portfolio management, research, trading, strategy, obviously from my perspective. So we're building a really interesting ecosystem down here. So, but just a little background on myself, and my connection to Atlanta. And just once again, like to thank you for having me.
Thank you, Shayan. The room that I'm located in right now, we had a team of your colleagues from BlackRock led by Kurt Ruoff come and speak to us last year about the state of the economy. A lot has changed since then. Yeah. And so it's a great pleasure to have you here. I'm not going to take too much time because we have so much we want to hear from you. And so let me just frame the scenario just for 2 minutes. Just about 100 years ago, there was another pandemic called the Spanish flu, which incidentally was not called the Spanish flu because it originated in Spain or anything like that. It was because Spain was not part of an agreement at that point in time. But anyway, that was a really, really major pandemic, and people have been looking to that to see if there are lessons we can learn from what happened during that pandemic. So during that pandemic, over 50 million people died globally from that pandemic. The year after the pandemic, the stock market bounced back really, really strong. And then the year after that, it hit one of its records, right? To this day, it's, I think, the fourth sharpest increase. But times were different. It was different because at that time, we also had a World War I, which meant that there was a lot of manufacturing activity that was essential that was going on. Number two, manufacturing was at that point in time the significant part of the US economy, as opposed to service right now, right? So service is the biggest chunk of the US economy by far. And as a result, there are things that now we are able to do with technology that was not feasible back then. Even though we had face masks, we had people staying at home, isolation, all of that stuff, it was very different because there was no virtual world. I couldn't be connecting with you this way. I would have to have you in the trading room, and which I hope we will soon be able to do in order to conduct any activities. So things were very, very different. The entire global economy dropped a little bit, but not significantly during the Spanish flu. It's very hard to compare that to now because everything is different. For one, in this opinion of many people, including myself, this is more or less a catalyst for a major structural change that has been waiting to happen. And that has to do with the technology revolution, the information revolution. Now, people in every survey are much more comfortable working from home than traveling for 1.5 hours through terrible traffic to get to their place of work. They're a lot more productive. So a lot has changed. One thing that hasn't changed is the uncertainty and fear that people have about their finances, that people have about their health and what they need to do. That was the same back then. That happens with every time we don't know about the future. Therefore, we look to people like you to shed some light so that that fear is removed, that uncertainty is reduced. We know how to, what we are looking forward to. So without further ado, let me introduce the two co-moderators who are going to be running the show from now on. During the program, anytime you have questions, just type it in the chat session. I'll be monitoring that, trying to aggregate them, and I'll bring it up at the end, depending on the time available. So feel free to do that. So let me start with Raicheal Kringali. She's the Chief Operating Officer of the Student Managed Investment Fund, which is run as an LLC here at the Coles College. I'm in their office right here. That's the Hensler trading room behind me. She's the Chief Operating Officer, does a fantastic job for us, is just phenomenal in so many aspects. She's also a great student, and she's a member of the Coles College Scholars Program, which is a great honor in its own place. David Lee is our Chief Investment Officer. He's also a double major in information systems and finance, in both of which he excels. As a chief investment officer, he is responsible for helping guide us and training the students on how to manage a small portfolio. So without further ado, Raicheal, please take over.
Thank you, Professor. On behalf of David and I'd like to thank everyone for being here. Since I get the honor of asking the first question, I figure I'd go ahead and thank people. So Mr. Hussain, I want to kind of set the scene a little bit. So back in the spring and the summer, we hear about the Fed cutting the interest rate, and kind of, people are looking towards kind of fixed income. What can it provide for them instead of, riskier stocks? Is there a place for fixed income in a market where the rate is so low? Can you kind of talk about the mindset of people right now?
Yeah, no, absolutely. That's a great question to start out with. And I'm actually going to build on, I think, one of the points that Professor Hariharan mentioned, and this moving to work from home. And, it actually leads really well into the story around fixed income, where you think about March, the markets basically broke down. Like I don't know how many people are aware, but the markets came so close to actually collapsing, the functionality of the markets, where, the most liquid asset in the world, US Treasury debt, you actually had a pretty hard time trading. We look at on the run versus off the run securities, and the bid ask actually widened out dramatically. So it was an amazingly challenging time, and it was actually, given that vol, you think about the standard deviation move that we had in terms of risk off. Treasuries are traditionally meant to be your hedge, your diversifier to risk.
Right.
But there was a period of time in that it was that Friday at the beginning of the month where markets first sold off. The next week, it was just vol just spiked. And Treasury rates actually moved marginally higher, which is very, counterintuitive. Treasury rates should move lower. Prices should appreciate. There should be a flight to quality. But that was a function of just markets totally breaking down, where you had this just evaporation of liquidity. The 2 points I want to make around that. First, with regard to the professor's point in terms of work from home, something we're really proud of at BlackRock. We went to complete work from home mode at a time when the market was totally collapsing, when it was falling apart. There was no one in the office. At the same time, the function, you think about $7+ trillion of assets, we were able to maintain without missing a beat. It was so impressive. And, I don't know how many people on the outside really get a feeling for, can have an appreciation for that. But to move to complete work from home mode at a time when the market is literally, the fabric of the market is falling apart, and to manage portfolio risk and to fund client liquidity, i.e. where clients are requiring cash, provide that cash in a timely manner, it was nothing short of epic. It was pretty amazing. But, I highlight that point around, the breakdown of markets and the rates market in particular, where, part of the challenge is, well, duration, treasury risk is meant to be a diversifier to portfolios. And in a zero rate world, I think that's one of the bigger kind of questions that one must ask, oneself. And, in answering this question on fixed income, let's say versus stocks, one point I would say, just flat out, I think as a younger person, like in your position, or I would already even argue my position, but even though I'm 20 years into my career, but I would be 100% stocks, given a longer term time horizon. But that being said, not everyone has that luxury in terms of individual investors. As you get closer to retirement, institutions that by their policy statement have to hold fixed income or need to fund some level of income in their portfolios. So when you think about, fixed income, there's really three reasons that, people invest in fixed income. It's income, that's inherent to the name, capital preservation, and equity diversification. And I don't think anything's changed from that perspective. However, the current rate paradigm does have very significant ramifications in terms of rethinking traditional portfolio construction approaches to like a multi-asset portfolio. So let's say a traditional like 60-40 portfolio, we would argue today's environment does require to kind of rethink that construct. And there are different tools that need to be utilized, and there are implications with regard to the benchmark, and I'll get into that. But let's go through those three components. So income, capital preservation, and equity diversification. So first, on the income side, think about this statistic. It was actually highlighted in the Financial Times a couple months ago, or a couple months ago. But if you went back to, kind of the turn of the century in year 2000, over 50% of the market, of the global $60 trillion tradable global fixed income market, over 50% of the market yielded more than 5%. You look at that number now, only, and I would argue it's probably less, but less than 3% of the $60 trillion tradable fixed income market trades with a yield greater than 5%. So when you think about, income needs that people have to fund retirement, and you've been accustomed to historically, we're not getting that now. And you really got to think through that. And I think there is a negative externality in terms of, Fed policy. Obviously, zero rates, tremendously beneficial to, kind of preserving market liquidity and functionality. Second, in terms of spurring economic growth. But at the same time, the unfortunate byproduct is that a zero rate policy ultimately penalizes savers while benefiting borrowers. So that's why you have all this debt being issued, whether government debt or corporate debt. But the Fed has made it abundantly clear, and whether you look a few weeks ago at the the Jackson Hole meeting or the recent FOMC, they're going to keep rates on lower for a longer period of time. I keep the front end pinned down, and the market hasn't priced out to close to 5 years, which is, I don't think is that far out of the realm of reality. And I'm happy to get there. I think there's a lot of interesting kind of stuff we can get into with regard to Fed policy. I think it's a dramatically different regime and a dramatic departure from the last 30 plus years of monetary policy. It's a big deal, and it's a big change, and I think has significant ramifications. So when thinking about fixed income, ultimately your starting yield is the primary indicator of your forward return, in fixed income. And, a good way to think about that, the last time, it's interesting, the last time the Federal Reserve took the Fed funds rate down to zero, the yield on the Barclays aggregate index was actually closer to 4%. So if you were just pull up on your Bloomberg terminal, hey, what's the return on the ag since, December 31st, 2008? You'll see your realized return has actually been around 4% annualized. So your starting yield reflective of your forward return. Now you look at that broad benchmark index, the yield on the Bloomberg Barclays Ag Index is 1.15%. So very different experience going forward. And that's not taking into account the rate paradigm where you could have rates back up. So, you look at you could Google BlackRock's capital market assumptions. It's we publish it on our website, but the 5-year expected return for, the aggregate index core fixed income is 0% annualized. Over the next 10 years, it's 0.8% annualized compared to 4, over the last decade plus. You look at credit, double B high yields yielding around 4. To get anything north of 6, you got to go out to single B or triple C, below investment grade credit. So you got to take on a hefty amount of risk, and you're going into, more concentrated sectors of the market, particularly energy, which tend to be your lower quality issuers in the space. So to put into perspective, and I know none of you were around at this time period, but if you were to go back to the mid 1990s, and just if you Googled like 3-month CD rates, just pull up a chart. It's actually on the St. Louis Fed. It's published there. It's a cool chart to think about. But if you went back to the mid 1990s, you could have gotten 6% on a 3-month CD. You could have gotten 6% in cash without doing anything. Now you can't even get that in the high yield bond market. You got to go out to triple C to get anything north of 6. Think about the exponential increase in terms of the level of risk that you need to take to achieve yield. So what does that mean from an income perspective? I think ultimately, fixed income serves a very important role in terms of income. I think the expectations have to be, managed going forward. But that being said, there is opportunity in fixed income, but I think you just need a broader kind of approach. So you look at areas like securitized areas of the market, like commercial mortgages or non-agency mortgages, CLOs, and you can get some pretty healthy yields in the 4 to 5% range while staying in, kind of IG to maybe double B portions of the market. Look at, high yield loans, even looking outside the U.S. as well. EM corporate credit, Asian corporate credit as well. Europe appears to be turning the corner. You're getting some interesting yields there, particularly as you hedge the currency risk back to the dollar. So point being that you can get yield, you can get income, but it just requires a very different approach in terms of expanding kind of your range of investments and also thinking about how do you put the pieces together to optimize for risks. So that's the income component and the implications there. Now let's think about equity diversification. So fixed income, it's meant to diversify, the equity portion. It's at the center of traditional portfolio construction theory. And if you look at traditional mathematics, I mean, we're and you look at the level of rates, we're confined or limited by the zero lower bound. And you have a 10-year treasury that's yielding roughly 0.7% currently. And the Fed has made it abundantly clear that they are not going to go into negative rates. It's very different from Europe. So let's say the limit is zero. So there's an asymmetry there in terms of how much further rates can move lower versus how much rates could potentially move higher. And think about this. So when you think about the Fed funds rate in historical recessions, on average, the Fed funds rate has declined by about 400 basis points, meaning the Fed cutting interest rates. In this response, it's been about 175 basis points, and now we're at zero. What do you do? What does the Fed do? And obviously, the Fed has moved more towards quantitative easing and forward guidance. But the reality is there's less of a hedge there. There's less of a benefit of rates moving lower where stocks sell off or credit comes under pressure. Our view there is that fixed income can still serve a role as a diversifier, in portfolios. But you just need to be more tactical where you hold your risk. So the front end of the curve, as I mentioned, is just totally overpriced. With the market pricing the Fed lift off out to 5 years. But the curve is, if you look at the yield curve, it's actually steepened out a pretty healthy amount. And we would argue you're getting that diversification benefit on the back end of the curve. So that's really where you want to express your kind of duration exposure. So point number 2 around equity diversification. Fixed income still serves that role. You just got to think about it, differently in terms of where you sit across the curve. And I would argue, and this is something we do in our multi-asset portfolios, you got to think through alternate hedges to hold in a portfolio, in a multi-asset portfolio. So for example, gold is a very interesting hedge, albeit it may be more correlated to risk sectors. So you want to think about how you utilize it and how you size it. But under a scenario where things take a turn for the worse in terms of the virus or whatever it may be, global growth, Fed's made it pretty clear they're gonna do more. And what that does is it forces real interest rates, so the interest rate net of inflation, further into negative territory. And that serves as a boost to gold. So gold could serve as an interesting hedge going forward. I would argue you probably want to hold more cash in a portfolio than you have historically as a hedge. There's other hedges like the yen, which is a flight to quality source. So maintain fixed income can serve as a diversifier, but you may need to think about alternate sources of diversification. And then 2 other points to note here, in terms of capital preservation, it's a really interesting question. Fixed income, for the most part, has been that kind of quiet part of your portfolio. It's just kind of like set it and forget it. Not really a lot tends to happen in your fixed income. But here's the reality. I think the risk return is going to be very different going forward, where there's the 2 metrics I would look at is the yield that you're getting paid versus the duration risk, meaning how interest rate sensitive is your bond portfolio. And if you look at the broad benchmark index, as I mentioned, it's yielding about 1.15%. The duration, meaning a measure of its interest rate sensitivity as measured in years, has actually extended from roughly 4 years to 6 years. So you just do the math, which is the change in rates times your duration equals your price loss in terms of rates moving higher. It only takes 15 basis points, so 0.15% in terms of rates moving higher to wipe out your entire yield. And now your total return is in fact negative in that kind of traditional core allocation. So, what does that mean in your fixed income? It means you need to be more thoughtful in terms of the balance between duration risk and credit risk, and using credit risk, that yield, to serve as a buffer. The last point to make, and I know I've been talking a lot, but I think it's such a good question. The last point to make here is, if your bonds, so let's think about this from a comprehensive portfolio. And if the bonds are meant to serve as a hedge to the equity risk, and now the diversification properties of the bonds have been compromised to a certain degree, now the aggregate risk profile of your portfolio is actually increased without you doing anything. So, obviously, using hedges, cash, gold, et cetera, on the fixed income side or outside of that. But I would argue, I think we got to rethink our equity allocations as well, and maybe start to look towards bond-like equities. So equities that throw off a consistent dividend over time, and maybe even grow over time as well. So here's an interesting way to think about it, to quantify it. So longer dated investment grade bonds yield about 2.6%. Over a 5-year time horizon, that would equate to about a 14% cumulative return. Now let's look at kind of these solid dividend companies that have decent dividend growth, like Comcast, McDonald's, Starbucks, Merck, J&J, a few good examples. The average dividend yield you're getting there is about 2.7%. So that equates to about an 18% annualized return. In addition to that, you look at the cash flow these companies are generating. They're actually generating about a 15% return on capital. So if that return on capital is going to accrue to the book equity, that compounds from a book equity perspective over the next 5 years at about 100%. So hopefully that gives a good perspective that I think there's still very much a need and a role for fixed income. We just need to think about it differently, think about alternate hedges as well. But then also I think it means we need to address the equity side of the portfolio as that kind of, and I'm thinking about it from the perspective of like a traditional 60-40 portfolio. I know I kind of droned on a bit, but it's actually something that we're thinking about right now, and you're actually going to see some papers published on this topic shortly from BlackRock. So it's very much a real-time discussion. But Raicheal, let me know if that answered your question or if I veered off topic too far.
No, yeah, that was great. Thank you so much. And to your point, I think, outside of the finance industry, COVID is making us rethink so many things. And so, that was a great answer. Again, thank you for that. David?
Oh, yeah, I think that was a great answer. I really enjoyed the note about equity-like or equities that were fixed income-like, because we have to do that for our student managed fund because it's a equity-only fund to sort of hedge our risk. So for a while now, specifically in like equities and those sorts of markets, there has been a trend of certain more popular stocks moving away from trading off of fundamentals and seeming to trade off of investor sentiment. And during the coronavirus, I wanted to know if you thought that this trend had started to accelerate, in addition to the trend of value towards growth, sort of similarly moving alongside this trend.
Yeah, that's an interesting question, and actually something we were discussing, prior to jumping on the call. I think maybe let's, it's important to separate kind of the noise from the facts. And in terms of the noise, without a doubt, I think you had a bit of exuberance from a tech perspective in terms of the run up that we saw. And a lot of that reflected in the options market. The size of the call volume was just like insane. Something we were actually doing in portfolios, we were actually selling calls into that. Just you look at the skew in the options market, it was insane. So basically people were just buying hand over fist upside calls on Facebook or Tesla or, you name it, Apple. And you look at the levels there again, they're like, wow, I think you're getting paid an amazing amount to sell into that optionality. So we were actually selling calls, and we felt there was this kind of crazy skew happening in the options market. So I don't know. I think there's obviously a lot of focus on kind of this kind of Robin Hood dynamic, and where you've had a lot of, investors taking a larger, kind of recreational investors maybe taking on larger positions and influenced by the options market. And it can be a self-fulfilling prophecy where, the folks that are selling that insurance are hedging their positions by being, long stocks. And so as the market moves, it just kind of compounds on itself and accelerates it further. So, and then obviously you have the SoftBank dynamic, and that obviously is kind of speculation around what took place there. But the size of the notional is pretty significant. I think you had a lot of that air being taken out. That being said, then the question is it real in terms of valuations? Is it real in terms of tech and growth dominance, which I think is a good question that you have. So there's a couple ways to answer this question. First, I would think about it just as a traditional NPV analysis, so net present value of future cash flows. And one thing that obviously we focused on the previous question, Fed took rates to zero, and the Fed has made it abundantly clear that rates are going to be at zero for a very long time. So when you think about your NPV analysis, the Fed has taken your discount rate to zero. And under that type of scenario, when you think about your DCF, what's going to influence your DCF more? It's not near-term cash flow. It's actually longer-term cash flow and the growth trajectory of that longer-term cash flow. Then the question is, well, is that real? And I would argue, yes, it is very much real. And why is that? We are firm believers. We are just at the precipice of this technology revolution. And I think, to use Professor Hariharan's terminology, I think he's spot on. We are, we've obviously seen a tremendous amount of evolution just over the last decade, but we're just at the tip of the iceberg, I would argue. There's a couple of good books if you guys are interested in this topic. I mean, I'm kind of like a junkie when it comes to kind of just this tech space, but there's this author, Andrew McAfee. He's an MIT economist, and wrote a book called Machine Platform Crowd. Also a book called the second Machine Age, I believe it's called, or Second Industrial Revolution, something to that effect. But it's wild what we're just at the precipice on. And, we're just at the next stage in terms of, you think about machine platform crowd, we're at this amazing intersection of machine computing capacity, the platforms being created, i.e. Facebook, Google, Apple, and then the crowd component, i.e. the data that's being fed into the system. It's pretty amazing. And so when you put all those components together, the introduction of 5G technology, the level of data that's being produced, you can't even quantify at this point. But helps to fuel things like the Internet of Things, artificial intelligence. I think we're just at the precipice of this. So I think we could debate as to the valuations of Alphabet, Apple, Microsoft, Facebook. But one idea I would put forward is these companies are kind of like the utilities. So think about a company like AT&T. It doesn't feel very innovative at this point. If anything, it feels like a dinosaur. But at the advent of the invention of the telephone, think about the range of companies and industries that were born from that technology. I would draw a very close correlation here, which is Google, Apple, Microsoft. They're the platform, and the amount of value and business that will be created off of this. I mean, I forget the number. The Apple Store alone, the level of commerce that takes place, it dwarfs other portions of the market. It's dramatic. I don't have the number off the top of my head, but point being that to also draw on Professor Hariharan, one of Professor Hariharan's comments around the Spanish flu, and obviously manufacturing being a large part of our economy. Think about in this services-oriented, kind of space, and I would argue, in terms of how commerce is done and via these platforms. Back then, think about the amount of investment that you need to make to start a company, to build a business. It was significant investment. Now, on these platforms, you can create scale instantaneously. With a fraction of the capital investment to, and versus like traditional business models. So I think that's what we're really talking about. And I think that's why, we've been, when you talk about this kind of growth versus value argument, I think it's a discussion that we need to be really careful with in terms of thinking through. Since, a value stock may be a value stock for a reason. And, I'm kind of, speaking out of turn to a certain degree, since I went to Columbia Business School, which is the home of value investing. Obviously, Jeremy Grantham, and it's Warren Buffett, the home of value investing. But and I don't think value investing is going away. I just think we need to think about it differently. Where value stock may be value stock for a reason, and the reality is the rapid pace of technology and the evolution of technology is just leaving businesses obsolete, and that's the reality. So, if anyone remembers on this call, Nokia, companies like Nokia or BlackBerry, those were once considered value stocks. Those companies don't exist anymore. They're totally obsolete. So I think we really need to be careful, like how we think about value. But I think there are really interesting opportunities in companies in traditional industries that are on the right side of technology. So, for example, a company like Walmart, look at the earnings on Walmart. It's amazing. And look at how much they've built out their online platform. And it's not just distributing their own products, but also third-party products. And they have the distribution system in place via the stores, through in-store pickup, or even at-home delivery. Walmart's a stock to watch. I think it's a really interesting name. You look at this week, Nike, really strong earnings. You obviously had the stock rally. I think it was up 10% or so. But earnings surprised higher, mainly driven by digital sales. So digital sales for Nike was actually up 82%. Compared to last year. And you look at, from a headline perspective, total earnings was only down 1% compared to last year. And that's in the midst of a pandemic where the entire economy shut down. It's pretty phenomenal. So, point being, once again, a long-winded answer, but hopefully helpful, where I think there's some reality to that. And I think you've had a decent shakeout around that. But I do think that there's some reality to it, in terms of, thinking about monetary policy, when thinking about, us being just at the precipice of a dramatic, revolution in terms of technology. And if you read those books, among many, I can send some other recommendations, but Elon Musk's biography is really fascinating too. But yeah, I think we're just at the beginning of some pretty amazing things. We have this chart. Sorry to go on a tangent, but I can send it as a follow-up. We just show going back to, I think it was back to like 1900, but the introduction of new technology. So like, the steam powered technology in terms of like the turbine engine or whatnot. And then the rate of adoption for those respective technologies. And it's gone from this like J curve like that, modest slope, to literally like that. It's it's really unreal. I'll send you that chart. It's pretty phenomenal, but I think that's what we're thinking about. So I think there's reality to it as well. But David, let me know if that answers your question.
Yeah, no, that was good. I think that companies with a strong digital platform will definitely outperform, especially with all this going on and us being at home and in the middle of the pandemic. The trend towards digital platforms and work at home and like technology not just being its own sector, but being kind of touching on every other sector is helping a lot with the growth companies.
Yeah.
I'm going to go back to Raicheal for the next topic.
Yeah, I definitely ordered a few things from Nike over the course of my kind of pandemic stay-at-home thing. So I'm happy to say I contributed to their number. But I want to kind of pivot a little bit because I know that you said you talk about careers during this conversation tonight. So, with the current hiring and, recruitment situation due to COVID, do you have any concerns about the long-term effects that this could have on new employee performance? Because of training, maybe, having to be at home or something of the like.
Yeah, no, I think it's a two-sided coin. And, I do think that the work life will be very different going forward, even as we get past COVID, where, I think there still is that office dynamic, but there's less of this kind of 5 days a week grinded out, get into the office, right? Where it's like you come in when you have these group meetings and you kind of collaborate, and then you kind of break off, and then you can obviously collaborate digitally as well. But point being, there's things that need to be done in person. And one of the things Larry Fink, our CEO, has talked about is just the impact that it has on culture. That's something that we're keenly focused on, and we are excited to get back into the office from that perspective, where it is a big part of the culture. Just the random conversations walking down the hall. Like I can tell you, in our office, like Lucas actually sits closer to the elevator, and on the way to the other side of the floor. But if I'm walking that direction, I'll usually say hi to Lucas and his team and just say, hey, what's going on? How you guys doing? And there's some value to that, and it creates a culture, right? It creates a sense of kind of belonging and a togetherness and all that stuff that Lucas talked about at the beginning. I think it's reinforced by the in-person dynamic. So I think that's important, and we're very much excited to get back to the office, to do that. The flip side of the coin is, I think the COVID experience has also brought us closer together, ironically, where we've created these forums and utilizing technology for a broader dissemination of information. So whether it's like the chat, like we have an internal chat, like IM, and we have these groups that are created, like, we have like our, Atlanta office chat that we created and has grown because of the pandemic. Just the back and forth there, just congratulations on this, congratulations on that. I feel like I'm just much more aware of what's happening in the office, actually, and what people are doing, where we were a big part of, or we played, not a big part, but I think we really energized as an office around the Georgia hate crime bill, and put that as a priority for us in terms of trying to make sure that gets through as a piece of legislation. The back and forth on the chat was inspirational, in terms of people saying, hey, I'm going to do this, I'm going to do that, here's what you should do, maybe you guys don't know about this. Or we were talking about the situation with the elections, and there was information put out about how you can become a poll worker. I didn't know that. So it's actually brought us together. The other thing that's really cool is, for our junior folks, we created this weekly forum where a senior member of the team, so whether it's myself or someone on the investment team, will interview someone on the investment side, and the targeted audience is kind of the analyst to VP level globally. That's never been done before. And from what I understand, we have roughly 400 people that consistently tune into this. That's never been done before. So point being that, yeah, I think we do need to get back in the office. I think that there are certain complications where you just need that personal interaction, personal touch. But then also, I think we've created some things on the back of technology that have also taken us to the next level in terms of global connectivity, in terms of information flow and sharing, that I hope we keep in place even post-COVID, where it's been really powerful and really beneficial from my perspective. So yeah, so it's interesting to see what this is going to look like on the back end of this, but I'm optimistic.
Yeah, I know David and I have, we enjoy being in the Hensler trading room, the room that Professor Hariharan is in. And, I learned a lot just from being in that room surrounded by people that are way smarter than me. So, it was interesting. I feel like I picked up a lot of good information that I wouldn't have learned, just researching myself. So it was great. David, do you have anything to kind of add?
Yeah, no, I miss being in the SMIF room, not being able to just walk in and see all the analysts there and then help them on the reports and stuff. We're trying to put something together now to try and bridge that gap in teams and whatnot, but it's tough.
Yeah, I think to build on that point, in the time period that we're in right now, so I was kind of talking going forward, but like it just requires a lot more effort, so it's me picking up the phone, calling someone junior on the team and just saying, hey, how's it going? Like, how are you doing? Like, how's life? What are you, doing to keep yourself busy in COVID, and how's work going? It's trying to manufacture those informal conversations, but it does require a degree of, being intentional versus when you're there in person, it's just, you kind of take it for granted. You're all there. So that just happens naturally. So it does require a lot more effort. I have a lot of catch-ups on my calendar. It's insane. Like,
Yeah, no, I definitely agree. Professor Hariharan, do we have time for one more question, or are we going to send it over to the chat?
Yeah, let me just, as long as Shayan promises to give us some time, give you and David some time later on, because I know you have a lot more questions. It's too exciting.
Yeah, we had a lot of questions prepared.
So let me just run through 3 questions that have been posted in chat, and you can answer them in whichever order. One of them is, if you've never invested, how do you get started? That's from Terry Ziegler. The second is, if fixed income continues to become more correlated to equities, at what point should investors prioritize alternate hedges? And the third one is, how do you expect the current situation with COVID to affect onboarding new hires?
Yeah.
Okay.
Okay. Great. I can. I'll just jump right in. So maybe I'll start with the third question. We haven't stopped. I mean, we have a large analyst class, coming in, and it's we've moved everything to virtual. Like I said, it just requires more effort, but it hasn't changed the numbers in terms of summer interns, nor kind of full-time analyst hires, and there's just a lot more being done virtually, and a lot more checking in on folks to make sure people are in a comfortable spot and feel that they have a supportive environment and that they're learning. And so, like I said, it just requires a bit more effort, but yeah, the numbers are still quite strong. And we're I'll put a plug in for Atlanta. We're pumped to build the office here in Atlanta, and we have a pretty big summer analyst program and full-time hiring program. So very excited, from that perspective. I'll note that. Maybe I'll answer kind of the second question. So in terms of the correlation to equities, these things tend to happen. If you looked at historically the correlation to equities, it actually changes over time. So it's not a consistent hedge, albeit I'd say over longer periods of time. I think it works as a hedge. One thing I would think about, where I think I would argue, as I mentioned, I think fixed income works as a hedge. Why is that? Well, because the Fed has introduced, or has, I'd say, supported that diversification benefit. Why is that? Well, basically because they've said that they're more willing to cut than they are, than their, proclivity to raise rates. Meaning that as data improves, as inflation moves higher, they're going to be on hold. They're going to sit back and say, you know what, I'm going to be patient. I need to see more consistency here. And so the implications for fixed income is that where data is strong, it should help mitigate how much rates move higher. But where we know that the Fed's going to do more, if things take a turn for the worse, then rates will move lower. So I think the Fed's positioning helps preserve, the functionality of fixed income. If you were to go back to 2018, this is when things break down, which is the Fed wasn't really clear. So, you had the change from Chair Yellen to Chair Powell, and Chair Powell just was not extremely clear. And you had a bit of back and forth in terms of policy, and the Fed was moving towards tightening, and it wasn't clear what their trajectory would be. So as you had improving data, the market started raising rates, started pricing in a lot more tightening, and fixed income sold off at the same time as stocks selling off. So that would be a scenario where I would say, hey, I would think about getting out right now. But I don't think that's the case right now, and I think the Fed is committed to holding the line in terms of its policy. I think the last question, I love this question because it's something that I talk a lot about. I speak on our Atlanta kind of office-wide meeting with market updates, and I remember when we were back in March, folks asked me to get on and kind of give a market update. And actually, my first comment when I jumped on was, if you were ever to be a student of the markets, now is the exact time to do it. Like when things are good, and stocks are going up, there's not a lot of vol going on. Like there's not much you're going to learn, but now you have vol, things are breaking down, things are changing. Monetary policy, fiscal policy, global growth dynamics, trade, commodities, this whole thing with stocks and, the options market. There is so much to learn at this point, and so many things are happening. This is actually the best time to learn, if you were to want to get into investing. So, what I would suggest is just read, just have a discipline in place where you're like, you know what, I'm going to read, these websites, whether it's, I think there's a lot of great, kind of blogs out there. Obviously a lot of news sources. I personally love the FT. So that's my go-to. I have to read it every day, start, front to back. I feel like the FT gives the most global perspective. I find their writing to be much more kind of academically rigorous, and have a lot of really amazing writers that gets more, I would say, in the weeds on things. I don't ignore the journal, but I only have so much time to read. I also read Barron's over the weekend. Barron's gives me a good perspective in terms of general investor sentiment. It tends to be reflective of kind of retail sentiment and what are the hot topics. And I spend a lot of time talking with retail investors, but I think Barron's is a really interesting publication, and it covers a lot of different asset classes, and it'll be very timely in terms of, the topics covered. I'll also give us a plug for free content, which is the BlackRock website. So if you were to go to blackrock.com, and if you looked up the BlackRock Investment Institute, you can actually subscribe to our weekly newsletter. There's a lot of blogs that we post. There's a lot of white papers that we post on different topics. So I would argue, just read. And then the other thing I think is just put your money where your mouth is. Put some risk on the table. It doesn't have to be a lot of money. It could, just be $100 or something. But have a view. Think about all the data that you've digested. Have a view. Put some money on that view, and now you're tied to it. And then the amount you're going to learn from that will be unreal. That's what I did in college, and you learn how to make money. You learn how to lose money too, which losing money can be probably the more educational part of it. There's this book called the Diary of a Stock Operator. It's like a legendary book, but it's more focused on the commodities market. But it's like from this one of the greatest traders of all time. And basically what this person does is go through their discipline where, they just have this notebook every day, write down notes on the markets. Here's what happened, blah, blah, blah. Here's what happened in the fund, in my book. Here's what I did well. Here's what I did poorly. Here's what I could have done better, or what I would do differently. And what I took away from that, something I've been doing since I started at BlackRock, actually. So since 2009, I keep a daily log. So I'll just, every day I write down, thoughts on the market, looking back at yesterday, here's what happened, here's what was different. Like, why did gold move this direction when stocks went this direction? Why did, treasuries not rally? That's odd. Well, it may have been because of this reason. And when you start doing that, you start thinking about this like mosaic of different asset classes, and, but then you start putting the pieces together and you start connecting the dots. And I think the beauty with markets is no one's right necessarily. And you can have a different opinion, and you can be right in your own right. So I highly recommend, having a journal. And I have a bunch of notebooks, and I think it was like 2 years ago. 2 years ago, I moved to OneNote. So now everything is on my OneNote, which is pretty cool. So now I can just search things. So it's pretty cool. So I would recommend doing that like on OneNote or Evernote or something like that. Just keeping a journal in terms of your learnings and observations on the market.
Fantastic. Thank you. Stephen Elgin, you have to come visit us and see the trading room, etc. It was just starting up when you were in school here. And Shayan, I hope again you would come and join us in the very near future. Lucas, of course, is always welcome to come and visit us. Robin, can I hand over to you?
Absolutely. Thank you so much, Govind and Shayan, especially for your time and wisdom and answering our questions today. I know that Raicheal and David could go on for hours, so we may have to take you up on that offer, Govind, to get to speak with you one-on-one. We'd love to have any of you come and visit our SMIF organization. It is certainly one of the students that I'm most proud of in the Coles College of Business. But on behalf of all of my colleagues, so again, John Preston and CCHC and Wilman and College of Science and Math, thank everyone at BlackRock for your time, for your dedication to Kennesaw State University, and for coming to start this series. For everyone else on the call, please keep on the lookout for 2 more sessions. The last 2 sessions were BlackRock on October 14th and November 4th. So with that, I bid you all a wonderful evening, and thank you all for your time. Thank you.
Thank you for having me.
Absolutely.